So today, we are talking about graphic packaging. And specifically, we're going to unpack what happens when a company's stock drops almost 10% in a single day. We're going to get into the earnings report that really shook up investors and take a look at the new CEO's pretty bold plan to turn things around.
Wow. The market did not waste any time making its feelings known about graphic packaging's latest results. The stock took a nosedive, plunging nearly 10%. Now, when you see a reaction that sharp, that fast, you have to ask, what on earth was in that report?
All right, to figure that out, let's just jump right into the numbers, because this is where the story gets, well, it gets a little complicated. There were a couple of good things, but they were totally drowned out by some really big problems.
Okay, let's break this down because it's a real head-scratcher at first glance. You look at the top line, revenue, and hey, it's a beat. $2.1 billion, better than Wall Street was looking for. But that is pretty much where the good news ends. Adjusted earnings per share, just 29 cents. That's a huge 19% miss. And then came the real gut punch, the guidance for the full year. Management thinks they'll do somewhere between 75 cents and $1.15 in earnings. The Street, they were expecting close to $1.77. That isn't just a miss, it's a massive, painful reset of expectations.
So this is the core of it, right? It's a tale of two completely different stories. In the good column, you've got solid sales and a promise of absolutely huge free cash flow. We're talking $700 to $800 million. But in the bad column, well, the company's ability to actually earn a profit right now seems to have just fallen off a cliff. And that outlook was way worse than anyone was prepared for. It's pretty clear which column the market focused on.
So the big question is, how do they fix this? Well, that's where the new CEO, Robert Ria Pro, comes in. He's actually coming from the other side of the table. He spent his career as a customer at places like P&G and Kimberly-Clark, so he's bringing a totally fresh perspective and a new game plan to get things back on track.
And this quote, this tells you everything you need to know about his new philosophy. He is basically saying the days of just hoping for a better market to save them are over. The message is loud and clear. We're not waiting around, we're turning inward, and we're going to aggressively execute on the things we can actually control, like costs, efficiency, and fixing the balance sheet.
And its plan is really a back-to-basics approach. It's all about a few key things. First, get profits up by hammering down on costs. Second, get all that extra inventory off the books. And third, use all of that to generate a ton of cash. And what are they going to do with that cash? Priority number one, pay down debt. Simple as that, all while they conduct a top-to-bottom review of the entire business.
So you might be wondering, how in the world do they get to that massive $700+ million free cash flow number? Well, it's not really a growth story, it's a discipline story. Step one, they're going to slash capital spending by almost $500 million as a huge investment cycle finally ends. Step two, they're going to pull about $260 million in cash just by getting their inventory levels down. And step three, they're creating a brand new transformation office whose only job is to hunt for more ways to save money.
And this whole new playbook really sets up the central conflict here. It's the reason the stock drops so hard. You've got this major disconnect between the story the market is obsessing over right now and the one management really wants everyone to focus on for the future.
What we have here are two completely different narratives. The market is stuck in the now. Investors see production cuts that are going to hurt earnings, they see a ton of competition and too much supply in their main market, and honestly, they're just fed up with having their earnings expectations reset again. But management, they're trying to tell a story about the future. They're pointing to the incredible cash flow that's coming after this big spending cycle, a healthier balance sheet, and a much leaner company. So you see the problem? The market is selling the short-term pain, while management is trying to sell the long-term gain.
And if you want to understand why investors are so frustrated, well, just look at this chart. Over the last year, graphic packaging is down a staggering 47%. Meanwhile, the S&P 500 is up over 15%. That is just massive underperformance. It explains why investors have absolutely zero patience for another just wait, it'll get better story. They've been burned, and they need to see results, not just hear promises.
Okay, so with all that as the backdrop, what do we need to look for now? Let's put on our analyst hats and talk about what we think is coming down the pike.
First off, brace yourselves, because the first quarter is probably going to be pretty ugly. Management was clear that the biggest production cuts are happening now, so that's going to squeeze margins. Don't even be shocked if their debt-to-earnings ratio actually goes up a little bit before it starts to come down. The real green shoot to watch for will be any sign that prices are finally stabilizing in the paperboard market. But, at the end of the day, this all comes down to one thing: execution. The new leadership's credibility is on the line. They just have to deliver.
So, what's our final call?
We're rating this a market perform. Look, the problems right now are serious, and that guidance cut was a real shock to the system. But the new CEO's plan makes a lot of sense, it's credible, and the potential to churn out all that cash is very, very real. This is the definition of a show-me story. We're not ready to bet against them, but we're not jumping in with both feet either. We'll be watching very, very closely.
And of course, just a reminder that this is not financial advice. This analysis is for informational purposes only. You should always do your own research before making any investment decisions.